Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. We begin this hour with stocks higher on reports of a more targeted US tariff approach. Sharon Miller of BlackRock writing, we stay overweight US equities on our tactical horizon of 6 to 12 months as policy uncertainty should ease over the period. John joins us now for more. John, good to see you.
Great to see you.
More confidence being long stocks versus bonds. Just help us understand the why.
Well, on the bond side, I think we are high conviction that we are observing right now a resetting of global rates higher. It's a big story. I think we see fiscal spending being everywhere. This is in part in reaction to the foreign policy of the U.S. And that has still to play out. So I guess being underweight bonds is high conviction. On the equity side of things, we remain of the view that we are at uncertainty right now is maxed out. Never seen that before. Along many policy levers, objectives are not clear. And so all that together, I don't think can last forever. I mean, that's not good for anyone. So we think over the next few weeks, as we get more clarity, I think markets will be able to get on with whatever is the destination. And that's the overweight.
Markets where? Markets in the United States? What about markets elsewhere that have actually rallied into this decision? I'm thinking of China. I'm thinking of Europe.
Yeah, so I think right now this has been the opposite, right? So we've seen the rest of the world outperforming the U.S., but on a 6 to 12-month horizon, we expect to go back to the U.S. taking the lead. I think this is partly because on the European side, even though we are a bit more positive, we turn neutral, we used to be underweight. We think this is more of a narrow story. It's military spending, it's banks, and it has some momentum for a few months, but we don't think this is yet a macro story that's going to carry Europe for the next 12 months. So we expect to revert back to U.S. taking the lead as a result.
If you put these two ideas together, the idea that we're seeing a structural repricing of rates and that you still are overweight the U.S. or expecting the U.S. to take the lead later this year, do you think overall equity returns are going to be constrained by this repricing of rates globally?
So we don't think rates are coming down. We think the 10-year yield in the U.S., which has been rallying, is not the story we're going to see going forward. So there's going to be an adjustment. But we think that, there's deep forces that will reassert themselves. AI, we still are, very bullish on AI being a powerful source of drivers' returns. And as a result, we think it's possible to withstand higher rates, moderate increase in rates, and withstand those for equity. If we get a very significant adjustment in rates, which is not impossible given the uncertainty we're facing, depending on the policies that will be put in place, then it would challenge the view on equities, I guess, for the U.S.
In the United States, yeah. Do you think that the U.S. is going to be the main beneficiary from this AI megatrend that you've been talking about for quite a while? Or do you think that increasingly you and your colleagues are starting to think about China as also being maybe not as much of a beneficiary, but a significant one with some of the advancements that we're seeing currently?
Yeah, I think both are set to benefit from the AI story. I think both China and the U.S., we think this is where it plays out. There's a bit of a Middle East story as well, but it's not a global story. So we think this is more powerful in the U.S. I think the U.S. eventually provide an environment where we're more comfortable with, I guess, on the macro perspective. So the AI story is playing in both places. I think the macro backdrop eventually is more positive in the U.S. That's why the combination of macro and AI favors U.S. over China for us.
It's interesting you mentioned the Middle East. We just had Sheikh Tahnoon down in Washington and the UAE saying they're going to invest more than $1 trillion in AI. But a lot of that is almost contingent on them being able to get access to these chips. Is that all the leverage the U.S. holds? They have all the power?
I think that's part of it, right? So there's First of all, it's a story that is very, very high barriers to entry, a massive amount of capex that is needed to be a player in that space, and I think so. You need big firm with big balance sheet. It's possible for other countries with deep pockets to play a role in there, but I do think that the U.S. does have the upper hand on this at this stage.
When you see positive news like that, but then you also see banks coming out and potentially raising their probability of U.S. recession, how do you weigh the two?
Well, I think right now the part we haven't talked about, we've talked about the 6 to 12 month horizon with our view that eventually we get back to a better place. But for now, as I said, the uncertainty is kind of peak level. I don't think I've ever seen so much a range of views on what might happen. The commentary on the outlook is as wide as I've never seen. It's as political as I've never seen it, and as a result, that is holding back people. And the longer it lasts, then I think we don't think a recession is in the card. We think there's a lot of resilience. In fact, I don't think the recession is the biggest risk. I think the biggest risk is long-term decision, infrastructure decision, and so on. That if they're put on hold, we're going to see a lower structural growth rate in the U.S. eventually, and that's a much bigger deal than a recession.
You keep talking about how later this year we'll get to a better place from some sort of policy level or from a certainty level. What does that mean at a time when we keep talking about uncertainty being a feature and not a bug of this administration?
I'll give you one example in the tariff. I think, right now there is a debate. There's uncertainty about what will be the impact of those tariffs for the U.S., for the trading partners. And you can make an argument that it's going to be minimal. It doesn't hurt the U.S. Once the evidence comes in, I think the leverage of this bargaining chip will be waning. And so I think one way or the other, we're going to see a reduction. It's going to be harder to dismiss the damage from tariff. It's going to be harder to just make bold statement about we're going to go with even higher tariffs, and I think you're going to see a convergence someplace as a result.
Is that the moment to buy bonds when we actually start to see that? Or is there another reason why you just don't believe treasuries are going to play that role this time around? I
think the underlying forces, we don't think inflation is resolved. I think the Fed last week has painted the most optimistic scenario and they've included that in their forecast on the tariffs.
You don't buy it?
I don't buy it. And then I think the fiscal side, we'll need to see, but we have hope of tax extension coming in, so we know this is going to make the deficit wider if that's the only thing happening. The saving is much more uncertain. So I think the fiscal story remains one of deficits and putting pressure on yields.
When you open up the SEP and you look at those forecasts from the Federal Reserve, which piece of that jumped up to you and said, that's aspirational, I don't buy it?
Well, to me, the most revealing part of the SEP and the press conference last week was when asked about whether this is a one-off story, inflation. I think the chairman was very careful to say, well, we don't know for sure. Last time it was. But when he answered a question later about when they would get concerned about inflation, he said, well, if we were to see inflation appearing as part of the economy that have nothing to do with tariff, then we would get concerned. That's, to me, like doubling down on this is a one-off. They see the tariff as being a one-off, and so that definitely stood out for me.
Do you not think it is a one-off?
I think it could be, but and it was last time because it was very targeted. If we're talking about broad-based resetting of global trade, I think there's going to be adjustment. I think the cost of doing international production will be higher, and it's not like just a tax or a tariff. It's the broader adjustment, higher cost of production for some time.
You've heard the argument from economists that because employment anxiety is higher now, the second round effects will be dampened. People won't be able to ask for a raise. You won't see those second round effects of that spike in prices. What do you say back to those people?
I think we have a very tight labor market. I think that the Fed sees this as being balanced. I think we have seen over the last few years immigration playing a massive role in helping the labor market cope with a lot of tightness. I think that is the big story going forward. So I'm not sure that the bargaining power for wage negotiation will shift that much.
Ask for a pay raise. Good news.
Okay, really? Yeah. Really, you're on a mission. Man, I wonder what
I don't like that psychology shift that shifts away from the,
Please,
towards the employer. And
yeah. Well, I'm keep fighting it.
Not asking for a bowl of whatever.
Yeah.
It's not Oliver. John Boivin of BlackRock. Thank you.
Thank you.
For America publishing its newest small businesses checkpoint. The team writing the following: despite continued optimism, small business uncertainty is on the rise. According to aggregated credit and debit card spending data, small businesses are slowing their card spending across the board. Sharon Miller, the president and co-head of business banking at Bank of America, joins us now for more. Sharon, good to see you.
Good to see you
too.
Good morning.
Let's talk about the little spots of weakness that we're starting to see emerge. Where are they and what's behind it?
Well, we are seeing weakness in manufacturing firms, especially the smaller manufacturing firms, so those with 500,000 in revenue and below. But as you look at the larger companies, we're still seeing strength there. We're seeing strength in retailers, with the exception of furniture.
Which really shows the sort of ad hoc nature of some of the threats and how different companies are responding to it. Before we dig into the specific sectors, I'm wondering the difference between big and small businesses. You said small businesses are slowing their card spending across the board. Is that the right distinction to make, small versus big?
I would say small versus medium-sized businesses. So when you think of our segment, it's anywhere from startup to 50 million in revenues. So you have small and mid-sized companies within there. But generally speaking, we're talking about $1 million and below company when we're saying smaller businesses.
What's the standout? What industry has been very strong at the moment?
Well, we are seeing strength in retailers, with the exception of furniture, but restaurant spending is strong. We are seeing strength in, shopping, going out to eat, all of those types of retailers, e-commerce. So I think that there's some trends there. And so you have to see what the data is telling you, not necessarily what the consumer is telling you.
Is this a leading indicator? Are these card data tending to point to strength or weakness depending on where we are in the cycle?
Well, I think it's a wait-and-see attitude. I mean, there are things on the horizon and some dependencies that businesses are thinking about, whether it's tariffs, the political environment, taxes. How is all that going to come to life as they're thinking about CapEx for their business?
Let's sit on CapEx. How do you get a decent idea of whether those CapEx decisions are being delayed, pushed back, or just totally derailed? Which one do you think it is at the moment?
I think it's delayed. I think it's a wait-and-see attitude where you're still seeing people spending on their business, albeit not as strong as we had seen last year. So there is some wait-and-see out there because they don't know what's going to happen. And so as I'm talking to clients around the country, that's what I'm hearing as well. We do want to expand. We do want to invest in our business, but we're holding off just a bit to see what's going to happen.
Sharon, as you know, these companies have a massive role to play in employment in this country, and we're starting to focus even more on the hard data and the employment numbers that come in every week, jobless claims. Now, if you go into a wait-and-see economy, how long before you start to say, we're not going to hire, we're going to fire? Is there a lag time? Is there a typical framework timeline to think about this, or are we in no man's land?
I wouldn't say we're in no man's land. I mean, we've got to watch the data every week, every month, and what's happening in the economy. But I would say that in business formation and those that are actually putting together plans to hire businesses, we are seeing an increase in the number of new businesses opened that are talking about, I'm going to employ people. And so that is good news as you think about where we are today versus, pre-pandemic levels.
Are there significant exceptions? We were talking about sort of the ad hoc nature of who gets hurt and who doesn't. Are there areas, small pockets, where you are seeing real deterioration?
I would say we are seeing a little bit of deterioration in manufacturing, especially in those firms less than 500,000 in revenues. In furniture, that's the only retail category that we did see a decline. And so those two areas are areas that we are watching.
I find the retailer point absolutely fascinating, and I think it reinforces what Chairman Powell said just last week, that you can read too much into the sentiment survey data to look at what people are doing. And right now for him, for many, for economists too, they're looking at the hard data and it's still holding up, and there's not much to see here.
When you take surveys online, there have been studies that show that people tend to say that they feel less good. And a lot of these surveys are online. And so they all rant online, I feel terrible, why? And then they say, oh, I'm going to go shopping. And this is sort of what has been bearing out.
Retail therapy.
Exactly, in the data.
That sounded personal, Bramo.
I'm just saying, it's always, those texts that you said to people where you're just ranting, and then you're like, okay, now I'm done, and I move on.
Is that how people approach you, Mitch, when it comes out on Friday?
You want my opinion on the world? Pretty much.
Sharon, it's good to see you, as always. Thanks for being with us. We appreciate the update. Sharon Miller there of Bank of America. with a consumer. Investors looking ahead to consumer confidence later on this week. Dana Telsey of the Telsey Advisory Group writing frenetic is an apt word to describe the current environment. Key measurements such as consumer sentiment and volatility in the stock market reflect the anxiety out there. Dana joins us now for more. Dana, good to see you as always.
Nice to see you. Thank you for having me.
Are people pulling back? That's what we want to know. Do you see it in the channel checks?
We are seeing it in the channel checks. When you look at the earnings results that are coming out from retailers lately, the fourth quarter almost feels divorced from what you have in the first quarter and going forward. You look at the guidance that companies are giving out in the consumer space for the first quarter. In essence, we always know the consumer area is a third and fourth quarter weighted. But now the first quarter is expected to be, for the most part, weaker than consensus and what consensus had out there. So you need to accelerate even more rapidly. And that word frenetic, the reason I like it, I looked up the definition, anxiety-inducive activity in a wild and uncontrollable way. And that's what it feels like today.
Consumption has been super resilient for the last several years, but beneath the surface, beneath the headline numbers, it's been very bifurcated. Low-income consumers have been squeezed for quite a while, a number of years now. High-income consumers have held up. Is that still the case? Because if they start to go, this is over, what's the story?
I think the higher-income consumers moderated their spending a bit. You look at what Delta Airlines said a few weeks ago, and Delta is the premier airline with a premium price of 20% or more. You're still seeing the Uber high-end doing very well. You look at Hermes's results and the double-digit increases. But everyone else out there, it's a state where it's not as robust as it had been. And consumers are discerning. Look at what Costco said, where they've seen a shift to people eating at home. And we're seeing more evidence of that type of behavior. What do you need to win? You need newness, you need events, you need activation in order to drive interest. I was on Friday and on Saturday, I was downtown at the opening of the new Printemps department store, the first one here in the U.S. The wait was around the block. So there's interest in newness.
Do we have a sense then, just to that point, of who might be using this as an excuse? The idea that there's consumer hesitancy, so why not kitchen sink it, throw all your problems out there, clear the decks, and then do what you want?
I think some of the companies overall who have been performing poorly, you're able to do that. You've certainly taken a look at some of the lower-end department stores that have had some of those issues. But many of the others, they're hoping that they can still see that sell-through. The ones that are winning, brand leaders, discounters, and off-pricers. You definitely see even some weakness in some of the luxury brands that haven't been as strong. You look at some of the European brands like Keene, doesn't have the same robust posture that they had before, and they just found a new Gucci designer, so we'll see what happens. It'll be interesting to see LVMH's sales results when they report in mid-April.
Who do you think is going to be really caught in the crosshairs when it comes to tariffs?
The areas that are being impacted the most from tariffs, it's definitely some of the footwear companies, some of the dollar stores. And the speed at which you need to diversify, you can do three things. You diversify to other areas, you split the cost with the manufacturers, and you raise prices. But diversifying and paying the cost of manufacturers or them diversifying, it takes time. There's a reason companies went to China. It's fast and the labor knew what to do, and it's cost effective.
But when it comes to April 2nd, we're going to get this, quote, Liberation Day. Maybe it's going to be more selective than a broad scope. Mm-hmm. How are these companies preparing for that? They're not going to be able to move manufacturing in a matter of weeks.
They're including it in their guidance. For many of the companies, the guidance that you've seen for 2025 includes the tariff implications at the point until which they know how much the tariff is. Anything else? It is basically they'll need to reset again. And for the most part, in the early runnings, you're right, it's not a lot of the apparel world, but it is many of the other areas that raises prices for the end consumer.
So we've heard reports about certain companies, I'm thinking about Walmart in particular, that have gone to Chinese suppliers and said, all right, cut your cost by 10%, eat it. And they say, no, thank you, not going to do it this time. How much are you seeing that across the board, these sort of efforts to jawbone suppliers into absorbing it, not getting that, and so ultimately they will have no choice but to raise those prices?
I'm hearing about it from some of the bigger players, the smaller players also. They're all looking at other areas in which to diversify manufacturing. Not in the U.S. because of how expensive it is. Going to South America, going to Africa are some of the other areas that we're hearing companies work to do that.
Macy's has Macy's problems. Their stock is down by another 20% so far year to date. Do we need another
luxury department store in New York City. You mentioned Printemps. Do we need another one?
Overall, I mean, the location is a little bit different on Wall Street, but in saying that, there was people down there, certainly when I was there, around the block.
I noticed the same thing down there over the weekend.
Yeah.
I just wonder if that lasts.
We'll see. We'll know in a month or so, but I think that location is a little bit odd to get regular visitors all the time.
But they don't want to be known as a department store. I think the French are very upset about this.
Yes.
So how are they communicating that?
Five restaurants.
Hang on a minute. What are they upset about?
They don't. Printemps doesn't want to be known as a department store.
What are they calling it?
Experiential. They want to be experiential.
Purchasing of items.
They basically have
like
5
a Selfridges,
restaurants.
like a Harrods,
but
right?
much smaller. I mean, when you're thinking 55,000 square feet, it's 2 floors. Not all the restaurants are open yet.
The reason why is exactly because of the way that you asked that question. Do we really need more department stores? You have to wonder. A lot of people are thinking the same thing because Macy's was not a pleasant experience because it didn't really do it well.
Downtown's a bit of a ghost town on the weekend. We got enough footfall down there to make this work?
That's going to be the big question. They do have exclusive brands from France that are there. Since it's hard to get in, it's going to take time for everyone to see it and go back on a repeat basis.
Yeah, so I'm willing to go downtown to go see it, especially knowing there's lines, and there's probably even more lines during the week.
They've got one.
Right. Well, I agree. I will go back there to check it out to see how they're differentiating themselves. You would think there was other locations like that Barney's building, but that's much bigger than 55,000 square feet, and you need an anchor to bring people up Madison Avenue.
Oh, the old Barney's building.
Yes.
I used to like it there. It's
empty.
It's still empty, right?
It's still empty.
The one you're talking about, the one on Madison, not the one downtown.
Yes, Madison and 61st.
They need to do something about that, Dana. We'll sort that out. Dana Telsey there of the Telsey Advisory Group. Dana, thank you.
Thank you.
Good to see you. I was downtown. The Beekman was full. Lots of people there having lunch, doing drinks, all of that stuff. Then you go to Printemps. Round the corner, the line literally going round the block.
25% of the brands that they're bringing in, you cannot get in the United States. You literally have to go to France to see them. And I've been to Printemps in France, and I love it. Mm-hmm. So I'm very excited about this because finally you get access.
That's the
brands.
attraction.
I think that's the attraction. Okay. That's how they're going to win, potentially, and maybe the restaurants.
Once you get in.
Yeah, but the experience aspect is important. I mean, I think about that with my own younger cohort of sample size at home, and they talk about the experience of going to certain places and why they are willing to go to the place. It gives you somewhere to go. It's interesting.
You're socializing with friends.
Exactly.
Couldn't care less about the experience. Sort of like, I just want a friction-free transaction. You know, just want to
There's
go
something
in
for
direct.
everyone.
Yeah, I was about to say, if the whole world
I don't
were
want to
you.
talk to people. Just let's get the size and let's go.
These shops must really see you coming in and run. I'm the type of person that they offer you some champagne, then that's buying another blazer.
You're more expensive. that's taking a hit on the margin. I'm just direct. I'm much easier. They see
I want
me
the
coming.
wow of seeing something new. It's very exciting.
Make the sale. Coming up on the programme. Dana always got to say
thank you.
Let's stick with the economy. Kathy Bostjancic of Nationwide Mutual Insurance writing, if downside risks to our baseline forecasts continue to build, the FOMC may shift its focus from inflation to slowing economic growth and potentially deliver a rate cut earlier in Q3. Kathy joins us now for more. Kathy, welcome to the programme. That is the number one question that so many people have. If the Federal Reserve has sticky and above target inflation, are they in a position to respond to downside risks materialising in the economy? What gives you the confidence that they can do that later this year?
Well, good morning, John. And I should highlight first our baseline forecast is that they don't, that they wait until the fourth quarter and we only have one rate hike for the year. But what I was illustrating is that we continue to see downside risk building, right? You're seeing in the economic data, even if these tariffs, which you're talking about, maybe are more targeted and not as negative for growth or inflation, you still have a lot of uncertainty out there. I think even after April 2nd. It will have a little clarity, but still uncertainty. And that uncertainty is corrosive to economic growth. So my concern is that there's downside risk to our baseline and that the Fed, maybe they do need to come in the third quarter. Now, they have to balance things, right? Inflation versus growth. But if they believe, now Chairman Powell opened this, the genie bottle, right, and said, let the genie out, said transitory. If they really do believe that, then they can shift to growth because they're going to look through the tariff impact. But, tremendous uncertainty at this point.
Kathy, right now the market's baking in almost 3 rate cuts through the remainder of this year by the Federal Reserve. Do you think that that increases the risk of inflation picking back up in the scenario that you just laid out, where growth is slowing, inflation is sticky, and some of it, or a lot of it, can be attributed to tariffs?
Yeah, financial conditions, I think, overall are a bit volatile, and a lot of that due to the equity market, but we're also seeing corporate bond spreads widen a bit, not alarmingly so, but widen. So even though the bond market's pricing in more easing, the fact is, I don't think overall financial conditions have really eased that much. And if you look at the 10-year yield, it's quite volatile, but it still remains high. Mortgage rates are high. So I don't see that, easier credit flowing through to the economy and really jazzing up things. If anything, maybe it provides a little buffer. But I think there's still a lot of headwinds, hitting the consumer, hitting businesses at this point.
Which raises the question, Kathy, of whether Fed rate cuts will actually be effective at boosting growth. Will they be the same kind of put, if not on asset prices, then on the economy that they have been traditionally?
Yeah, it's... I think that what the market really wants is that Trump put, and we don't seem to be getting that as much, or at least the strike price is lower. But again, there is good news that the tariffs that will be announced on April 2nd could be more targeted, and those sectoral tariffs, maybe not on top of that. But again, we don't know. But I think with the Fed, I think we have to be careful to think the Fed is just going to come to the rescue. I think they could support growth if needed. But I think, so much really is coming out of the White House. The economic policy changes are really kind of swamping the Fed effect, I think, at this point.
Kathy, is it too early for Jay Powell to call it transitory when, one, we don't know how harsh these targeted tariffs are going to be, and we don't know the retaliation those countries may take on the United States?
Yeah, I kind of, probably like many people, kind of shuddered a little bit when I heard transitory, because we don't know. And we could continue to get like this dripping out of tariff announcements. And that could mean that the inflation impact lasts for longer. Even if it's not as big, it could last for long, and that complicates things, I think, quite a bit. So I think it was a little premature, and I think, they could, the baseline, their forecast is what it, is. Like, it does show a temporary increase in inflation and then growth slowing, but I think, putting that transitory stamp, I think that was a little premature.
Kathy, I think some people are confident because they believe the labour market's not as tight as it once was. And the potential for second round effects, the potential for people going out and saying, I want a bigger paycheck, and the company actually following through and delivering one, is somehow been dampened by the increasing employment anxiety that we've witnessed in some of the surveys over the last month. We got some pushback actually from BlackRock's Sharon Miller about 20 minutes ago on that point, and I think it was actually credible pushback. He said, you've got to think about the lack of immigration we're going to see over the next several years, and this labour market could well be tighter than people think alongside that tariff effort, and which would make us vulnerable to second round effects. Kathy, how do you think about the labour market dynamic? Because I think that point is probably the most important one.
Yeah, no, I think that's a great point. Like, yes, it's harder to go in to ask for a raise. Employers have more power right now. But on the other hand, just as you pointed out, John, less immigration means all else equal, a tighter labor market. If you look at the household survey, they dissect foreign born and kind of indigenous, domestic workers here, and all of the jobs that were created according to the household survey last year on net were for foreign-born workers, because we have a demographic issue here, right? We have people who are retiring, the baby boomers. So we do need immigration to kind of keep the labor market fluid, and it could get tighter than we all think, especially in certain sectors. Now, whether that transcends to the whole labor market, wage growth going up, maybe a different story, but certainly where immigrants are prominent in the agriculture, retail, home working situations, there you could see some wage pressure.
Hey, Kathy, appreciate your view, as always, and the clarity. Kathy Bostjancic there of Nationwide.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.